Thank you all for coming. Welcome to our webinar, Blockchain Frontiers. As you all know, Fahad and I have been working together on blockchain for some time now. In fact, I've supervised his thesis, which was the first blockchain dissertation in finance, and is now the only such dissertation published in a leading finance journal. We found the blockchain is an extremely interesting and practically relevant topic, and it covers many subtopics. To highlight some of these subtopics, Fahad and I decided to organize this session, which will discuss frontier ideas in the blockchain space. Specifically, our session today will consist of 4 presentations by leading academics that also possess unique practical knowledge. Our first presentation will be given by Silvio Micali, a leading cryptographer at MIT, and he will discuss Algorand, a frontier proof-of-stake blockchain protocol. Our second presentations will be given by Garud, Iyengar, an operations research faculty member at Columbia, who has collaborated with IBM Blockchain, and he will discuss blockchain for supply chains. Our third presentation will be given by Catalini, an MIT Sloan faculty member, who is the co-creator of Libra, and he will discuss Libra. Finally, our fourth presentation will be given by Darrell Duffie, a Stanford finance faculty member, and he will discuss digital currencies. So welcome again to all of you. Let's move on to our first presentation. Our first speaker is Silvio Micali. Silvio is on the computer science faculty at MIT, which may be at this point perhaps the least of his accolades. He's a leading cryptographer, having won the Darrell Prize, the Turing Award, and being an ACM fellow. A few years ago, he developed his own proof-of-stake blockchain protocol called Algorand, and he will be discussing that today. Silvio, thank you for being here. Please share your screen, and the floor is yours.
Thank you. Okay. Okay, let me get the right screen. Yes, I think I am.
Yes.
Thank you very much, Kose, for the kind introduction and the invitation. And thank you all for participating to this event. Glad to see that pandemics will not stop progress. Okay, so I'm here to describe an alternative blockchain technology, and let me explain why I think we do needed an alternative blockchain technology. The aspiration of a blockchain is very clear. It's a decentralized database that is readable by anyone, writable by anyone, and inalterable by anyone. The potential of a blockchain is unlimited. So who does not like a database that cannot be altered? Who does not like transparency? Who does not like the ability to generate trust among people who barely know each other? Unfortunately, in blockchain, there is a fundamental tension between aspiration and technology. As humans, our aspiration should be always higher and higher, but at some point in time, unless we sustain by technology, they will remain, the risk of remain up high in the sky. And our aspirations about blockchains were so strong that I claim they actually turned into self-deception. Take cover, a big wave of decentralization is here. Not as beautiful as the wave of Garud, but close enough. Okay, journalists, consultants, sociologists, anthropologists, the general public got convinced that decentralized blockchains were readily available. Really? Where? For the first few years, decentralized blockchains were pure illusion. So finally, after 10 long years, after 2000 and change blockchains, Buterin, the co-founder of Ethereum, courageously accepted that the blockchain aspiration remained unrealized. And he went even further by claiming that such a realization was impossible. Buderin's famous trilemma stated that no blockchain could simultaneously be decentralized, secure, and scalable. These three properties cannot coexist. You must choose at most 2 out of the 3. If so, which one should we exclude? Who wants an insecure blockchain? Nobody. Who wants a non-scalable blockchain? Perhaps somebody wants to set up a blockchain just for friends and family to play with. And if you are not interested in decentralization, why are you interested in blockchain at all? A simple database would do. There are no good options in the trilemma. The trilemma is simply not acceptable. Fortunately, it's false. Okay. The trilemma is only true for traditional technologies. So, but where is the difficulty? The challenge in blockchain was not in securing the chain, making sure that this database cannot be altered by anybody. Nobody can alter the order of a block or the content of a block. That was easy. Was solved by prehistoric cryptography. Defined prehistoric technology of 50 years ago, which in cryptography is really prehistoric. The real difficulty is choosing the next block. That's the challenges. Who should choose the next block on behalf of all of us, right? If I could choose the next block, I could decide which transactions the entire world sees and which transaction should never see the light of day. Such power would be greater than that of any absolute monarch. So let me try to see how the problem of choosing the next block was solved in prior technologies. The first technology, proof of work, by the way, a great idea of Nakamoto or the Nakamotos, is a great idea. The idea is that I should not choose the block, you should not choose the block, rather there is going to be a computational game. There is a very hard riddle to solve. The first one to solve it has the right to append the next block on the blockchain on behalf of all of us. However, this problem becomes ultimately centralized. Why is that? Because the complexity of the riddles keeps on increasing the more people try to solve it. And therefore, you must spend more and more computational resources. In fact, you must have thousands and thousands of computers in racks and racks, refrigerator. You hit the planet. And so when the expenses of participating to consensus become so hard, fewer and fewer people can participate. So not only you hit the planet, but you end up with a ultimately centralized blockchain. These days, the blockchain of Bitcoin is controlled by 2 or 3 mining pools. Okay, next idea. Next idea is delegated proof of stake. What does this mean? Simple. You see those 21 people? Don't they look honest? They do. And let me claim they will remain honest in the foreseeable future. So therefore, why don't we grant them the power to append a block to the blockchain on behalf of all of us? You know, proof of work became ultimately centralized, but delegated proof of stake is centralized by design. It starts centralized, continues to be centralized, and will be necessarily centralized in the future. Next idea is a bonded proof of stake, which is another simple idea to say delegate those who put money hostage in the middle of the table to choose the block on behalf of all of us. And their influence in choosing the next block is proportional to the amount of money they put in the middle, hostage in the middle of the table. Well, I claim that this is de facto centralized. Why? Because let me ask a very honest question. How much of your disposable income can you afford to put in the middle of the table? Not investing in anything and so on and so forth. So if most of the money in an economy is confined in the middle of the table, I'm afraid the West economy is not going to go very fast. I could continue, but let me somehow derive some conclusions. Essentially, the traditional blockchain technology relies on a questionable logic, namely, the whole economy is secure if the majority of a small piece of economy are honest. Sounds puzzling? It is puzzling. Here is the whole economy, and here is the small green piece that should remain honest. Who is the small piece whose security we depend on? The miners in Bitcoin, the 21 delegates in delegated proof of stake. Now, you guys are economists, I'm not, so you tell me, in the global GDP, what fraction of it is represented by the miners? Really? You need a magnifying glass to see them. Actually, even better, you need an electronic microscope, so small they are. So, an economy so structured, at the mercy of a small piece, is fundamentally flawed, in my opinion. In addition, the consensus arising was rather precarious. Let me explain. Somehow, the various previous technology allowed forks, soft forks, to arise, making consensus an eventual state. So assume that you see the blockchain, which is three blocks, and the last block contains a payment made to you. Wonderful. Should you ship the goods? Should you consider yourself paid? Well, that is unclear. Why is unclear? Because there may be a longer chain that will arise that bypasses the block where your payment is. That's the problem of forks. Somebody else solves a riddle relative to B2 prime and calls the new block is B3 prime. Somebody else solves the riddle about B3 prime and forms this other block B4 prime. And before anybody solves the riddle about B3 double prime, this is ignored. And what happens to bypass the branches? They disappear. Bye-bye all the transaction and bye-bye payment. All right. If you are a little bit upstream in the blockchain, your block is a bit deeper. Can you ship the good? Again, it's unclear because there can be some other longer chain. So the point is an eventual state, because the longer you wait, the more probable becomes that a block is going to stay on the longest chain. So the question is, how deep in the chain should a block be to be sure that it will not be bypassed by a longer chain? Is this deep enough? Is 5 block deep enough? Is 10 block deep enough? You know what? Enough is enough. So my thinking is that we should stop questionable logic, somehow precarious consensus, confusing myth and reality. Let's start afresh. So at Algorand, we decided to start an alternative blockchain. Its functionality and structure is quite different from the traditional ones, from first principles, because sometimes it's better to start from scratch than to patch something that doesn't quite work. So what is the different logic that Algorand adheres to? I think as can be summarized in 3 main points. First of all, no token is ever hostage. Where are the tokens? They are where they should be, in your wallet, ready to be spent at your fingertips or invested in the various opportunities that the blockchains offer to you. And every token has the same power, not 1 delegate, 3 delegates, 21 delegates. Every token has the same power as any other token to participate in the consensus. And what is the security? The security is if most of the tokens are in honest hands, then the system is secure, period. Another way to put it is that if you and I and a few others wants to destroy the system, we must first of all own a majority of the token and then shoot down the very economy, the majority of which we own, which perhaps to me is going to be a bit more painful thing to do. And the consensus is also different. It's not this eventual consensus, drip, 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 drip consensus. The more blocks, the more probable it is that I'm going to stay, but everyone agrees on the latest block before generating the next block. What is a big advantage of this? Is that there are no forks. And what does this mean? That transactions are final. As soon as you see a block added to the chain, and that block contains a payment to you, you have been paid, because in absence of fork, that block will stay on the chain forever. All right. And how do we actually proceed? What is the mechanism? We use some magic block generation, where the magic is actually replaced by mathematics, but it's a bit easier to talk about magic, isn't it? So let's stick to magic. Essentially 3 steps here at the conceptual level. 1,000 tokens are randomly selected among all tokens in circulation. How? By magic. Very good. Hey, these 1,000 tokens must belong to somebody. Their owners, by magic, become publicly known, and they essentially is a publicly recognized committee. And what does this committee do? Immediately, very quickly agrees and authenticates the next block. Guess how? By magic. All right. A few questions arise. The first one, I think, is the only one we have time for, which is perhaps the most fundamental one. Who chooses this damn committee, right? And the answer is, it's not going to be me, it's not going to be you, it's not going to be nobody. Rather, in Algorand, we rely on cryptographic sortition, this technique by which committee members choose themselves. You go, what? Committee members choose themselves? Nonsense. This is a terrible idea, maybe perhaps the worst idea that one can have, but not so fast. What does it mean that you choose yourself? It means that for each token you own, you can pull a cryptographic slot machine lever only once, and 2 outcomes can come from this lottery. Either you win or you lose. If you win, you get a winning ticket, a mathematical proof that you are part of this committee. Congratulations, listen to my opinion, because I'm part of this committee. Case 2, I don't win, I can say whatever I want, and nobody pays attention to me because I don't have the winning ticket. And the cryptographically fairness of this lottery guarantees that not even a nation state with huge computational resources can slightly increase the probability of being chosen to be part of the committee. All right, so if you want to be listened to, propagate your winning ticket and your opinion up or down about the block. Okay, let's analyze this. Now I claim that this is super decentralized. Why is that? Well, because every token counts. Every token has the ability to participate. More decentralized than this, Algorand, we have 10 billion tokens, you know, so that is pretty decentralized to me. Now I claim that this is super scalable. Why? How long does it take to pull down the lever? 1 microsecond. Gee, that is actually pretty fast. But if I have a billion tokens, it's a billion microseconds. No, it's a microsecond, whether you have 1 token, 2 tokens, or a billion tokens. That is the magic of this cryptographic sortition. So that is really scalable, because 1 microsecond is scalable. And if I win, I have to propagate 2 messages, winning ticket, and opinion about the block, big deal. Now I claim this is super secure. Let's pretend that I am a very nasty, ferocious, and very powerful adversary. I'm so powerful that I can corrupt, at the snapping of my fingers, 1,000 people anywhere on the planet. Whom do I want to corrupt? The committee members, because I want to control which block gets into the blockchain. But I have a problem, don't I? Because the committee members are selected by lottery, which is internally run by their computer, so I don't know whom I should corrupt. I should corrupt this lady in Shanghai or this guy in Paris. I have no idea. But wait a second. As soon as they propagate their winning ticket and their opinion about the block, now I know who they are and I can corrupt them immediately. But so what? Whatever they had to say, they already said it, and is virally propagated throughout the network. And I do not have the power, no more than the US government has the power, to put back into the bottle a message virally propagated by WikiLeaks. So the system is secure because beforehand, I do not know whom I should corrupt, and ex post is too late to do so. That is essentially the thing of the trilemma. So now I want to get into the subject of smart contracts because, in my opinion, that is really the main gift to the blockchain, of a blockchain to the world, right? And so smart contracts, the aspiration is a little bit, you continue to see the slides, yes? So the aspiration is very strong. Smart contracts are contracts among mutually distrusting parties that automatically execute themselves when the right conditions arise. Wow, wouldn't that be good? By the way, sometimes having contracts that don't automatically execute themselves may also be good, but you must admit there is plenty of room in the world for self-executing contracts. The potential are unlimited because you guarantee unmediated and secure transaction. You eliminate any financial friction. And by the way, it has been estimated, not by me, but 6% of the global GDP is dissipated in financial friction. If you can recapture even half of it, it's pretty good for even a developer country. So unfortunately, there is the usual tension between aspiration and technology. Traditional layer 2 smart contracts are very expensive, very slow, and very fragile. No day goes by that someone loses millions of dollars because of some smart contract gone wrong. So therefore, at Algorand, we developed two different approaches: layer 1 smart contracts and smart square smart contracts. What are smart square smart contracts? Are smart contracts that happens to be really smart on the layer 2, but I have no time for that today. I'm going to focus only on layer 1 smart contracts. So what are these layer 1 smart contracts? First of all, they are smart contracts, but they are executed at the consensus level. Therefore, at the very most secure level in any blockchain, and without slowing down block generation at all. Essentially, they are smart contracts executed with the same efficiency and security of ordinary payments. Let me give you a financial example, if I may. Delivery-based payment, that is a classical example. I have something that you want, you have the money that I want. Should I first give you the money? No way, you first give me the asset, or and vice versa. So what do? Traditionally, we use trusted mediator, but guess what? Trusted mediator, they want to be paid, as we said, and they're very rare. In fact, it may even be impossible between me and somebody, say, in Bangalore, to know somebody that we both trust to as a mediator. How about traditional smart contracts? Are you kidding? I just said they're slow, costly, fragile. How about hash time locks? Do you know what they are? Never mind. Whatever they are slow and they are actually dangerous too. So what do we do in Algorand is that essentially we do it by a single transaction. Within seconds, securely and directly, meaning unmediated, without writing any new line of code, you swap the things. How can this be possible? Essentially, what I do is the following. I give you my money, this money to you. If my giving my money to you, my digital signature of this appears in block 100, and your assigning your asset to me appears in block 100. So right now, assume that the block is number 99. So I push the button and say, I give you this conditional statement. And then a few seconds later, I look up in the sky and I see, oops, block 100 has appeared, and two cases occur. Either my payment to you is there and you're transferring your asset to me is also there. In such a case, we are done. Or my money to you is there, but your asset to me is not there, but my was only conditionally transferred if in the same block you are assigning your asset to me, and I don't see you're transferring your asset, and nobody sees. That is the ability to have a common decentralized database. And that is the power of this common knowledge, that we can actually have delivery this payment in essentially as an atomic swap. Conditional payments, we could do that too in layer one. Think about supply chain, that's a classic problem. I pay you if and only if you pay him, if and only if he pays her, and so on and so forth, right? That's a nightmare, but to have these conditional payments. Nobody wants to go first. We can do this in seconds. And we can tokenize an entire office building. And asset organization is really a big highway to liquidity. And you can specify at layer one in Algorand who is the issuer of this new class of tokens, how many initial tokens you issue, what is the maximum number of tokens you may issue in the future, who has clawback power, who has freezing power in seconds alone and without writing a single line of code. And you can do auctions. Think about running auction on a planetary scale in a transparent manner where everybody sees all the bids and everybody is guaranteed that a fair price has been reached and everybody agrees who has won what fairly. In fact,
Silvio,
a democratic
Silvio,
government...
2 minutes, Silvio.
2 minutes. And the collateralized loans that automatically transfer the thing. 90% of the needs of smart contracts can be satisfied. So layer one smart contracts with no intermediary things and with the same simplicity, speed, and security of ordinary payments may be a good idea. Let me conclude. The universal danger is confusing myth and reality. A good start if you realize you are not there, okay? Even if you are on opposite side of a very big cliff, because once you realize, it's only time that technology is going to span the distances and make myth a reality. So my take is that blockchain have the potential of really improving and uniting the world, but are sophisticated mechanism, and they do require sophisticated technology. Technology, I believe, is quintessentially human. Don't listen to anybody who says the opposite. Ever since we came down from the tree, with forming our first tool, we made ourselves more and not less human. Is the creative realization of our aspiration, is the response to our world, financial and non-financial, that keeps on becoming more complex. And technology is our past, our present, and our future. So happy future to all of us. Thank you.
Thank you, Silvio. Wonderful insights. We're going to hold the questions until the other speakers. Is that right, Fahad? You want to do the Q&A now, or?
Why don't we just see if do like a quick question, maybe if anybody wants to raise their hands.
Okay.
Take just one question, unmute you, and
I do see
well, it looks like Larry has a question in the chat. Why don't we? I can just unmute him and you can ask it verbally. Let's see, Larry.
Okay. My question is who's going to control the algorithm underlying Algorand? We don't want random people deciding on what code changes should be made. On the other hand, if there's a centralized body that controls the algorithm, they can always change the rules in ways that make the blockchain insecure. And as an example of where code changes have made a big difference, you recall that Ethereum went through a split to orphan a number of blocks after the DAO, a code flaw in the DAO was exploited.
Okay. So thank you, Larry. That's a very deep question. And actually, I believe that it is the most important question of all, because when you decide the code, right, is the code of an algorithm that exists. And traditionally, in blockchain, what you see is what you get. Actually, people go proud and say, law is stone, stone is law, or in law is code, the code is law. I mean, and say, I'm so proud that I will never change this code. I mean, I do not know any human activity that cannot be improved, okay, or any human function that cannot be improved. So if we create a ship that cannot turn, cannot be piloted, that goes straight in the same direction with no iceberg or no iceberg, storm or no storm, it's a recipe for disaster. So the way we do it is that actually, we have actually made 3 main injection of technology in our protocol, and we design our protocol to be upgradable, because somehow adaptation, intelligence adaptation is the essence of life, and it should be the essence of a blockchain. Particularly, the blockchain should serve us for centuries. And so the way we do it is that unless there is a 90% approval of the change doesn't kick in. And so when after you realize by on-chain that 90% approved, then from that point on, at a prescribed block later, then the new agreed upon protocol starts going on. And we have already done it 3 times, so it is possible to do it. And tell you the truth, we plan to do our update, because Rome was not built in 1 day, being myself Italian, but I think that this translates in every language and in every culture. So this is going to be a process. So I really believe life is about adaptability, and the moment in which we get tired of improving ourselves, we become dinosaurs, and we deserve to be supplanted, somehow displaced by a much more aggressive and energetic species.
Okay, we'll have a little bit more time towards the end for more questions. Let me go on to the next speaker, who is Garud Iyengar. Garud is OR Operations Research Faculty member at Columbia. He has won many awards, NSF Career Award, Informs Fellow. He has been involved with an IBM blockchain project through Columbia University's Academic Industry Partnership. And he'll be discussing blockchain for supply chain today. Garud, thanks for agreeing to present here. You're already sharing your slides. The floor is yours. Garud. Yes.
All right, thank you so much for inviting me to this session. I'm going to talk about joint work with Fahad, my colleagues Jay, and our PhD student Venjun at Columbia University. So in a way, this talk is very nicely segues from what Silvio was talking about. In this talk, I'm going to assume that the magic of blockchain has already happened. So Algorand is successful, it has taken over the world, and now we can use whatever algorithms they have to answer questions in supply chains. And the focus of this talk really is what happens when the technology is available. Is that really a solution, or do we have to do something more in order to achieve all the benefits? So what are the stories with supply chains? Supply chains are complex. There are random things happening. There are many different entities that are interacting. These entities have different incentives. There's a lot of record keeping that has to be done in order to make sure that things are satisfied to everybody's satisfaction. And because of the misalignment of incentives, this record keeping becomes very important. This record keeping is often opaque, erroneous, and that causes all kinds of problems. So in a way, a blockchain is an ideal data structure for information sharing. There's a single set of immutable entries, so you can trace things. There are privacy preserving operations available, which provides protection for private information. You can also decide who you share this information with, which groups of people, and so on. It's distributed, so it can be protected from attacks. And in a sense, all of these are great things. And to belabor this point a little bit more, currently what happens is every company stores data separately. And typically there's pairwise exchanges that happens between companies in case you want to trace things. And as a result, the interaction can often grow as n squared, where n is the number of companies that are involved in a particular space. The record keeping is typically paper-based, and that's a big, big problem for reasons other than even thinking about blockchains. The reconciliation is time consuming and expensive, both because of this pairwise exchange story and also the record keeping not being easily searchable, digital, and so on. So blockchains can solve all of these problems. There's a single copy on a distributed ledger. The exchange of information is typically redundant because each company has instant access to whatever information that they are allowed to view. And you can control that by putting privacy constraints in the setup itself. The record keeping is digital and reconciliation can be automated using smart contracts. So all of these things are great. So therefore, blockchains could be a game-changing solution, not just for supply chains, but for any situation where are cross-firm collaborations with different incentives. But incentive issues can often undermine adoption. And that's the focus of what Fahad, me, Jay, and our PhD student have been looking at. And I'm going to talk about that a little bit more as we go along and give you a little bit more applied picture. So as Kose mentioned, I've been involved through Columbia in a center called the Columbia IBM Center on Data Transparency and Blockchains. And this research has been partly supported by a grant from that center. And via that center, we've been talking to people at IBM and looking at various applications that they have been involved in. In addition to IBM, SAP also runs blockchains, and there are many payment platforms that JP Morgan and Goldman have come up with. And we will learn more about Libra later on in this session. In a supply chain context, this already causes a problem because there are different entities, different technologies, different ways of dealing with things, and that potentially causes a further splintering of the entire ecosystem. There's no standardization, and I'll come back to this issue a little bit later. IBM, since this is the entity that I know closest, runs several different blockchains. Food Trust is one of them, which is a food supply chain, involves Walmart and some other players. TradeLens, which is a global trade solution. WorldWire, which is a cross-border payment solution. And in order to understand what happens in the supply chain context and what benefits accrue and what things can go wrong, I'll focus really on Food Trust as a way to elicit all of these different issues. So Food Trust, as the name suggests, is to make sure that our food is trustworthy. Food safety is a very important problem. About 1 in 10 people become sick each year from foodborne diseases. 400,000 annual deaths from foodborne illnesses. A third of the food is thrown out as unacceptable. And the impact of these foodborne diseases is often amplified because of information bottlenecks. A particular bad or contamination of food will be discovered at a particular retailer or grocer. Technically, it should be immediately available all across the food network. It's not, because final traceability as to where it came from is difficult. And the reason it's difficult is system-wide visibility is often not there. Blockchains can enable early detection and recalls. Typically, several grocery chains source from the same supplier. A contamination at a single supplier can simultaneously impact several retailers. Efficient information sharing enables early and simultaneous recalls. So think about a situation, there is no blockchain, a particular retailer indexed by I recalls things at some random time TI. And this random time is dependent on what market share it has, what's the volume it's selling, how quickly are its customers coming back to them and complaining about the food they sold, and so on. If there was a blockchain, then every retailer becomes an experiment. And you detect a contamination not at time TI associated with a particular retailer I, but the minimum of TJ over all retailers J. And often this minimum quantity could be orders of magnitude smaller than any individual quantity. In particular, if there are sort of heavy tail distribution, this story can become much, much better. And therefore, blockchains can reduce both consumer illness and business expenses. What could be bad? Everything is good about it. Information sharing is fast. consumer illnesses are reduced, business expenses are reduced. And the place where things start to become sticky is that blockchain adoptions is not without cost. Older companies that don't have modern IT systems face larger costs in adopting blockchains. Older, established companies with large market shares are not likely to get too many gains out of it. And the reason is, again, going back to the simple idea of early recalls, if I'm trying to reduce the time that I detect a recall and I already have a large market share, by joining a blockchain, I'm not benefiting that much more. And if it turns out that I end up paying more for it, maybe I won't join. However, there's a flip story that the gains to the entire system is also very limited if retailers with large market share do not adopt. So already there is a need to somehow compensate people that are bringing in, quote unquote, more information to the system. And because the incentives of all the retailers is not perfectly aligned, even though societally you might benefit, it's not clear that a blockchain will happen in equilibrium. So there's a coordination problem since the gains to others depend on adoptions of others. And this issue has got nothing really to do with the technology, but with the fact that the way information is shared in a blockchain can make these kinds of coordinations perhaps even more acute at times. There needs to be a governance model for information sharing. Not all information can or need be shared, so companies are concerned with privacy safeguards. We can ensure that using cryptographic methods, but the blockchain governance models are still an open research topic. Governance is ad hoc, a systematic approach is needed. But here are things that potentially using a combination of technology and other innovations, we should be able to solve this information sharing governance problem. The focus really for us here was on understanding the misalignment of costs and benefits. Typically, in many of these blockchains, the ultimate beneficiaries of the blockchain are the consumers. And this is particularly the case in the food safety application that I've been talking about. But the consumers are not players in the adoption game. They don't have a say, essentially, on whether the blockchain is going to be adopted or not. The grocers and maybe the upstream farmers or farmers cooperatives are the people who might have a say in the adoption game, definitely not the consumers. The retailers or the grocers don't internalize the consumer welfare gains. There's a misalignment where retailers spend most of the money, but the benefits goes most to the consumers. And even when the adoption raises globally the welfare of the entire society, adoption may not happen. And the paper that we wrote, or that we've done so far, what we do is design sort of a minimal example that captures this particular misalignment and provides a solution of what to do. We consider a very simple business setting. There's a single vendor. The single vendor supplies to many manufacturers, and these manufacturers then supply to a bunch of consumers. So then supply chain that we've been thinking about is this particular figure, single vendor. Don't think about just manufacturer 1 and 2, think about manufacturer 1 and manufacturer N. There are N different manufacturers at the next layer. They all interact with the continuum of consumers at the third layer. The blockchain that we are thinking about is going to be formed among the manufacturers. The vendors have no play really. It's the manufacturers coming together to decide whether they want to form a blockchain or not. Consumers choose between the manufacturers because ultimately the vendors is the same on some quantity called quality, which I will describe in a moment. The vendors the vendor shipments, the reason we want a blockchain or we want to be able to understand what's happening in this blockchain is that the vendor shipments could consist of defective goods. And as a result, we need to be able to identify and perhaps even rectify these defective goods. To take the example of the food supply chain, food gets contaminated, defective foods can lead to serious illnesses, and the blockchain enables efficient tracing of these defects and thereby saving costs. Consumers want to purchase from high quality manufacturers. And in our setting, quality doesn't capture contamination. It's the other aspects about food that matters to quality: packaging dates, transportation time, which determines food ripeness, source, which helps determine ethical standards, identity of the source, whether certain processing standards are met, where was it, how far did the food come. Once you have a blockchain, all of this information can be put on the blockchain, and consumers could actually get this data and decide how to choose manufacturers based on this quality information. And in food trust, this is something that is central, that they are trying to develop metrics by which consumers would be able to make this decision. The information about quality does not help determine defect, which is because if it did, the manufacturer would not sell the item in the first place. So it's consumers decide on the basis of quality. Manufacturers are worried about defect because that impacts their reputation, that impacts recall, and so on. The manufacturers sit between vendors and consumers. And to put it back into the context of the food supply chain, grocers sells to consumers. The grocers face reputation costs if they sell contaminated food. Selling contaminated shipments or detecting contaminated shipments expediently reduces expenses. And having a blockchain with an immutable trail from the farmer to the consumer can help. It can identify the cause early. It can help early recall. It can reduce cost. It can improve reputation. So the manufacturer's welfare actually consists of three different components. Revenue, it can attract customers by signaling quality. High quality manufacturers could put their information on the blockchain and using this information attract more consumers to come to them as opposed to other manufacturers or in the food context, grocers. There's reputation cost. It can help reduce a blockchain presence, helps reduce the impact to the reputation by detecting defects early. However, there's an adoption cost, the cost of the IT infrastructure. So two things help, and one potentially is going to be an impediment to blockchain adoption. Manufacturers, since the manufacturers purchase from a single vendor, having a blockchain helps detect errors earlier, and this can be very beneficial. But one of the flip side that happens is that blockchains also reduce the error in the quality signal. So the good quality manufacturers can signal their quality and start getting consumers to move from okay or bad quality manufacturers to them. This can lead to a concentration of demand. And paradoxically, this concentration of demand actually hurts this identification problem that we were talking about and saying that this risk management from trying to have a decentralized large number of experiments and being able to learn from a large number of experiments, actually that benefit comes down because now the demand is getting concentrated. It also has an incentive problem because if you're a large market share manufacturer who is of low quality, you probably don't want to get onto the blockchain. If you have a very large market share, not having you on the blockchain will completely eliminate the benefits that you could get from the blockchain. So here are the three results of our paper, and that blockchain always enhances consumer welfare. Consumers get more information, and as a result, you always get better information and your welfare goes up. We find that blockchains actually may reduce manufacturer welfare even if there are no adoption costs. And initially we thought that adoption costs is going to stop the manufacturers from investing in a blockchain, but then we found that because of the concentration of demand, depending upon the distribution of how manufacturer quality is distributed among the manufacturers, even in the absence of adoption costs, some manufacturers may not adopt a blockchain. And it may not arise even when the total welfare is improving amongst all the society. And the reason for that really is that the costs are concentrated among the manufacturers and the benefits are typically concentrated among the consumers. And so unless there is a transfer mechanism available to take that welfare from the consumers to the manufacturers, and sometimes even among manufacturers, blockchain adoption may not happen. In this context, we also found that off-path beliefs start impacting what happens to the equilibrium outcome. And that is something unusual, and we are still thinking about what to do about it. So I'm going to stop here, and we have plenty of time for questions.
Thank you, Garud. Okay, so we have minutes for questions.
So we do have a question in the Q&A, but why don't we just have it asked verbally? So let me just unmute.
Hi, can you hear me?
Yep.
Perfect. Yeah, thank you. That was a really interesting presentation. I was really interested in this result that you stated that the blockchain will always enhance consumer welfare. And my question is really about what's the benchmark when you say enhances there? Are you referring to an equilibrium where we don't have any way to share quality information, and thus the blockchain is both providing this at the adoption costs you talked about? Or can we compare against something like a centralized quality monitor, something like the FDA or an equivalent international body who could also provide this quality information, maybe not in a decentralized way, but perhaps even still distributed?
So the way we modeled it is that every consumer gets a noisy signal of the quality of the manufacturers they interact with. So we looked at two different models, one where there is some search cost of switching from one manufacturer to another manufacturer, and the other one where it's globally available to you. So what we found was that having a blockchain reduces basically the noise that is associated with it. So in a way, if the manufacturers are willing to share all their data with a central monitoring body, I suppose they could do the same thing. So I imagine that in industries where you could get a regulator to look at all possible manufacturing issues, such as a drug or vaccine or something of that sort, I would imagine that you could get some of the benefits of the enhanced consumer welfare without blockchains. We were thinking about situations which are much more mundane, where the manufacturers will not be willing to share information of this nature to a regulatory body because it is something on which they are competing. It's not about, this information is not about defects. This is about, I sell the freshest produce, or my organic produce is sourced from, I don't know, within 20 miles. And those are things that are not necessarily as easily monitored by a regulatory agency, or maybe even the manufacturers may not be willing to share that information, but there may be an incentive for them to do it in a blockchain to get a bigger market share. Does that answer your question?
Yes, yes, it does. Is there time? Can I ask a follow-up question?
Go ahead.
Okay, thank you. Maybe specific to the food safety example, my understanding is that the global sushi market is, a place where it seems like a very natural fit for this food safety question you highlighted, where everything's very decentralized. It has all these reputational concerns because at the end of the day, the piece of fish I eat has very little to do with the original fisherman who caught it. And I'm curious, do you have any organizational knowledge about how that industry is currently solving its problem? Because it seems like a very direct mapping of this food safety supply chain issue that you're referring to in this paper.
I actually don't know. Yeah, that's a short answer. most of the focus seems to be in the blockchain world on agricultural products and more along E. coli and Listeria kind of outbreaks. And that's the place where most of the focus is. And in a way, I don't know about that market to tell you how it's going to be happening. One of the issues that I immediately see with that market, which has issues which agricultural produce don't have, is that lot size might be difficult to determine. Different fishermen find, catching a tuna might end up getting mixed, and it's not clear how to sort of solve the the binning problem in some way. So I unfortunately don't have a very concrete answer to give you.
So I have Garud, I have a quick question. What, in the supply chain context and in the context of making it more efficient and so on, what features of the blockchain are more important than others? That is, if there is an evolution of the protocols and things like that, what would you like to see strengthened and what is not that relevant?
Good question. So the features, traceability and privacy, probably those are the two things that are going to be most important. Being able to trace through the entire sort of record of how the goods moved between the various entities in a supply chain, and what information is visible to the different entities within the supply chain. So for example, if I'm a logistics provider, maybe the two entities that are trying to contract with me to provide logistics for them, I may want them to only share average travel times, may not want to share specific travel times for a specific shipment that I made, may not want to share with them which other players I work with. So a way to compute in a privacy preserving manner various pieces of the information would be something relevant, very, very important. And being able to do it fast. And of course, once you have these things, designing a smart contract that calls as a subroutine traceability and as a subroutine some privacy preserving operations, again, becomes an important feature on top of just a basal blockchain mechanism.
Thank you.
Given we still have a couple of questions, but given time constraints, maybe we can take those offline and move on.
Okay. Our next presenter is Christian Catalini. Christian is on the faculty at MIT Sloan. He's also the co-creator of Libra, which is the blockchain project being led by Facebook. Christian will present about Libra. Christian, thank you for being here today. You have already started sharing the screen. The floor is yours.
Thank you, and it's a real pleasure to be here today to give you kind of a high-level overview of the economic thinking behind Libra, both at the protocol level, but also when it relates to the stability, of course, of the coins. I would leave time for questions so that we can have an engaging discussion around, I'm sure, some of the issues that will come up. So, when you look at the overall objective of the Libra project, which is now an association-led project backed by over 25 members, it really is centered around financial inclusion and the belief that today too many people really do not have access to basic financial services. There's a large share of the global population that is supported by funds sent home by their family members. And especially in these challenging times, that source of cross-border flows is particularly important in a number of economic regions. Now, when you look at the World Bank estimates about the cost of sending remittances across borders, it's extremely high. So the average was about 7%. And of course, there's a wide dispersion around that. Even if you look at the subset of individuals that are kind of digitally native, and may use an online platform or an online or a mobile app, the average cost is still fairly high, 4.2%. On top of the high cost, you also have delays. It can take up to 3 days for some of these transactions to complete. And of course, there's the inconvenience, of course, in person, especially in a situation like the current one with COVID. When you look at the recent outbreak, a number of countries have rushed to implement, of course, different degrees of cash transfers and stimulus plans. And vast majority of these plans was really stifled by the time it takes, even in a developed economy like the United States, to just deliver, essentially a stimulus check to families across the countries. And so we do believe that digital technology, especially when coupled with interoperability, Darrell as a really interesting piece on the importance of interoperability in payment systems, and that has really inspired a lot of the thinking, in Libra in the latest iterations, especially since the release of the new white paper. We think that we can do substantially better, not only cross-border, but also domestically in many circumstances. Those ITs, affect not only users, but also merchants. Even in developed nations, the cost for payment acceptance is still fairly high. And there's a number of legacy costs from interchange to other fees that are hidden through the value chain that really stifle not only innovation, but also the transfer of value on a global scale. That leads to about 1.7 billion people that do not have a bank account, so are definitely unbanked, and there's also a larger share that it's underbanked, again, even in regions like the United States. Now, the good news is that a large share of these have access to data and to a mobile phone, and so that's where you can really start building a payment network that can enable an array of payment services and eventually also financial services over the long run. Now, why blockchain? When I started working on this and also looking at kind of the cryptocurrency and blockchain space, this was actually originally in 2013 as part of the MIT digital currency research study and experiment. What really, was always relevant to me was that this is a technology that enables new forms of market design. And so, some of the traditional trade-offs that apply to digital platforms, so to other arrangements in the economy, and I think we heard also from Silvio, kind of pushing the boundaries in the frontier of what the technology can deliver, is really important from an economic outcomes perspective. There's at least two fundamental economic costs that are affected by the technology. I think we've already talked, even in the last presentation, a lot about reducing the cost of verification. So the ability to really cheaply verify a digital state. And of course, you often have like a last mile issue of how do you onboard appropriately information that it's created offline, like in the supply chain, and ensure that those digital records are accurate. But once you do have that digital records, things like settlement and reconciliation become extremely cheap, even cheaper than it was possible already in digital platforms. But the dimension that's probably even more important, and this one relates to market structure, competition, and innovation, is what we call the cost of networking. So the idea that you can really bootstrap and operate a marketplace without assigning control to a single intermediary. I think we've seen a very big wave of innovation with the internet and the open protocols of the internet. Of course, that has led to some concentration in other parts of the economy over time. But what's interesting about blockchain technology is that if you design at the protocol level and eventually also the kind of economic layer, incentives in the right way, you can also drive the right type of competition on top of these networks. And as you'll see, a lot of the design of Libra is really targeted at ensuring that you get a vibrant and competitive ecosystem of applications and service providers that cover both traditional incumbents from the financial sector, but also new types of entrants in tech, and also smaller players like startups that want to provide new types of services with different kind of levels of service to merchants and consumers. Now, there's at least three core economic objectives in the design of the Libra network. The first one is building trust in the medium of exchange and essentially in the payment network itself. The second one is the one that I was hinting on around competition. And so ensuring that all the choices from the consensus algorithm to everything else that's part of the governance will really lead to competition and a leveling playing field between different types of players. And as you'll see often, the core answer to that is building open protocols. So things that deeply allow for interoperability, because as we know, interoperability from a standards perspective always plays in favor of the smaller player that is now able to access often the network of a larger one and compete on more equal terms. The last level, and we already touched on this, is really building trust in the governance and future evolution of the network. It has many features of a public utility and a kind of shared infrastructure. And so ensuring that there's, of course, the right level of investment in what are features like safety, compliance, and reliability of the network that everybody benefits from over the long run. But also that, again, the network starting distributed will keep a number of stakeholders and voices in its own governance, including, of course, the very important role of the public sector. Now, I'll start with the first one and kind of give you an overview of the evolution of the design, and then I'll delve into some of the other ones. There's going to be two types of coins on the Libra network. The first one are, single currency stable coins. You can think about a Libra dollar, Libra euro, Libra pound, and so on. And then there's also digital composite. This, again, taking advantage of some of the functionality of smart contracts, which you can think of a digital version of an SDR that will aggregate some of the single currency stable coins in fixed nominal, under fixed nominal weights. As you will see, these different types of coins will serve different purposes, and we hope to see kind of experimentation and innovation across an array of use cases, both domestic and cross-border. Now, for each one of the single currency stablecoin, we think stability is paramount. And so to really ensure that people can rely on this as a payment tool, each one will be backed 1-for-1 and actually will be over collateralized. Libra will be the first stablecoin project to essentially go through the rigorous Basel III framework, usually applied to banks, and really thinking through a number of risks that could emerge in an ecosystem like this, from credit risk, which of course is fairly minimal because the reserve will be backed pretty much entirely by short-term government securities. So think about 3 months or less, for example, US Treasuries, to market risk, so interest rate shocks on those same securities, liquidity risk, you can think about large outflows, and of course, all sort of dimensions related to operational risk of the network, both as a payment system, but also as financial infrastructure. The idea is to create a vibrant network of banks that will interface with the reserve and support the coin distribution. So this will act as designated dealers and interface with our usually called in this space VASP, virtual asset service provider. Now, the idea is to enable a number of low-cost domestic and cross-border use cases. Of course, the cross-border ones will be the most compelling at first. And over time, as you enable more of the single currency stable coins, you can also imagine a number of domestic use cases in different regions. And the goal is really to give maximum flexibility and control to central banks for how this payment system is really integrated in their countries. The future we have in mind is one where there is a form of central bank digital currency in all of these regions, and Libra is kind of a layer on top that enables additional functionality and additional services on top of the public sector API, if you want to call them that way. So Libra wants to be future-proof for a world where DCBDCs are present, and Libra would stop operating any one of these reserves and essentially switch to the public sector asset. Now, really quickly on the multi-currency Libra coin, as I was mentioning, it's defined in terms of fixed nominal weights, very much like the SDR maintained by the IMF. What's interesting is that once you do have these assets as digital and native on the Libra blockchain, creating something like a composite like the multi-currency LBR is extremely easy. So the smart contract can allow you to kind of think of it as stapling and unstapling each one of these coins as needed. Why would you want a multi-currency one? Well, it's a neutral, low volatility asset that can be used especially well for cross-border. Imagine sending it to a region that does not have a single currency stablecoin on the network yet and does not want to default to one of the other major currencies that will be available. So the idea here is really to support a number of use cases around remittances and cross-border payments. Now, there's a number of interesting challenges and important issues that were surfaced, starting with the G7 stablecoin report, the more recent FSB work on stablecoins. And so in the last year, we'll be working hard in really thinking through how would the Libra reserve weather a storm like the recent one we've seen with COVID or even 2008. so that at any point in time, there's a strong guarantee that users can really come out of the system and recover the value of these coins. As I was mentioning, we've gone through the same framework that you would go through as a new bank. We don't think the Libra network should be regulated as a bank, but some of the risks are similar, and so we're going through a very similar process in estimating what are the additional capital requirements and buffers on top of the one-to-one backing that are really there to absorb losses if they were to materialize. Now, other dimensions that are really important for the trust in the payment method really relate to transparency and auditability, and ensuring that the public at any point in time can really verify that all of the things that I just described are essentially true. When it comes to the calibration, and this is a process, of course, that we're going through with our lead regulator, FINMA in Switzerland, the basic intuition is that the requirements for the network will grow as the assets at risk will grow, and also if they were to ever become riskier. And for those of you familiar, again, with Basel III, there's going to be a traditional Pillar 1 capital requirement that Libra network will be expected to maintain at all times, and then additional capital buffers. This will be funded through the initial capital injection from investors, and then over time, of course, through retained earnings that the network can generate over time. Transparency will be, as I was already mentioning, extremely important. So regular audits and also transparent reporting of the backing, which again is fairly simple. And the idea is also to over time lift standards for digital wallets in terms of what are the financial responsibility disclosures. Are they engaging in more risky activities like lending, not on the network, but as part of the broader activities? Or, for example, do they have a legal requirement to enforce the full backing at their own level, and so on. As I was mentioning, the plan is really to plan for future integration with CBDCs. Now we understand that different regions will get to the path to a CBDC, probably in different flavors and in different at different speeds, from wholesale efforts to synthetic, maybe in some other regions. And we need to ensure that the network can integrate with all of these, including simple upgrades to RTGS systems and alike. Now, I want to move away from kind of the reserve and the coins and focus a little bit more about the protocol and really the resulting market for payments and financial services. One of the first things we did when we started working on this, now almost 3 years ago, was go through systematically through the economics in equilibrium of every consensus algorithm. And very much like Silvio's already covered, when you look at very prevalent consensus approaches like proof of work, there's a number of challenges that emerge in equilibrium in those systems. And I think we've already seen extreme concentration driven by mining in some of the systems based on proof of work. I think proof of stake, if not designed correctly, can actually lead to concentration, as was already mentioned, even at a faster rate. And so one of the reasons, for example, why we ruled out proof of work really early in this project was that the wasteful computation not only would have had massive negative impact on the environment, but also it was the wrong one to really incentivize validator nodes and participants in the blockchain ecosystem to keep improving quality. As it turns out, the main way to really avoid concentration and just more investment in wasteful computation in a proof of work based blockchain is through forking. That is the only threat that, for example, users or providers of services have against the infrastructure to improve competition and improve kind of the outcomes when it comes to quality of service. So Libra, you can think of Libra really as something that actually starts by building on the relational contracts and the reputation of the entities coming around its membership, and then scaling that up into a more dynamic system that's vaguely inspired by a proof of stake system. So that's where the members are really important in ensuring that when the network goes live, not only there's entities that have an incentive to defend the network, but also we're going to make the R&D and infrastructure investments in building this out over time. And here you're seeing kind of a description of some of the current members. They range, of course, from tech players to NGOs, academic institutions, nonprofits, and investors, venture capital firms that are really trying to build out together different aspects of both the social inclusion and financial inclusion mission, but also, of course, the payment network and the financial infrastructure. Now, what's interesting here, and this is where interoperability is really important, not only to competition, but also eventually to innovation and getting those kind of efforts on the extensive margin that we haven't seen, I think, for too long in financial services because of the lack of true competition in many of these networks, is that the network is not designed to be a walled garden. It's not going to be offering kind of proprietary APIs that merchants and others can integrate with, but is really modeled after the open technology standards of the internet. So think about TCP/IP, SMTP, and many others, or HTTP. We think that interoperability and that approach to kind of technology standards is really important for creating that leveling playing field. And over time, you will see more work on open and transparent membership criteria. This really gets at ensuring that there's going to be a thriving market and competition for not only validator services, but also effective governance. At its core, it's a network that's designed to promote low switching costs so that a consumer using a one wallet today should be able to switch to another one with minimal friction, possibly porting a lot of their relationship in a way that it's not like what happens today, for example, around banking services. Offers low barriers to entry and really this high degree of interoperability. And think of it not only at the consumer side, but also at the merchant side. If a merchant is accepting payments today with one payment service provider, they should be able to switch to a different one and so have a consistent pay with Libra experience throughout the network, regardless of who they're using as their service provider. We think that through competition, we'll also get to the goal of financial inclusion through lower prices, improvements in quality, and really the development of new types of services and business models that are currently precluded from the current market structure. Which leads me to kind of the most complex task, which is the long-term trust and governance in the evolution of the network. An independent and strong association is really key here, not only to ensure broad participation, so imagine competitors that would be competing for the market, at least collaborating in building this piece of shared infrastructure, but also founding members that can drive utility and adoption. I already mentioned their role in securing the network. For those of you familiar with proof of stake system, this really solves the nothing at stake problem that many of the systems face in their beginning. And Bootstrap, what you can broadly think as a market for delegation, so that consumers through their choices can kind of delegate governance and the growth of the ecosystem to parties they care about. The economics of it are very similar to the economics of traditional standard setting organizations. And the core of this is really distributed governance. So that we can really get out of the current approach of building very siloed solution, where often the same payment service offered within the same company to different payment services cannot even send money to each other today. Another important role of the association is really going to be to design kind of a classic tragedy of the commons and ensuring that there are resources for building the technology, building the infrastructure, securing it, and ensuring that it can advance over time through different services. Now, when we started the Libra journey, we did have kind of a description of how we would eventually transition the network to fully permissionless. But after a number of conversations with regulators, there were a number of concerns that many of the good anti-money laundering, CFT, economic sanctions provisions that the network is going to enforce could be removed in the future if the network were to transition to fully permissionless. And so what we're now doing is essentially blending some of the properties of permissionless systems with our current approach, which is going to have a compliant and control perimeter. We think that by bringing in, again, through the tools of market design and auction design, competitive forces back into the market for validators and also governance, we can get most of the benefits of a permissionless systems without running into the costs from an integrity and kind of financial compliance perspective. So just to give you a flavor of what we think is really important on this, we think that competition is really a prerequisite for building not only an interoperable but also an efficient and innovative payment system. So what do I mean for competition? People need to be able to build payment and financial services on top of it. They should be able to compete if they want to run validator services and contribute to the infrastructure. And they should also be able to participate in the governance and shape the evolution of the network over time. And the basic intuition is to build out an open and transparent market-driven process that will not only establish how membership expansion is done over time, but also what are the criteria for membership renewal. And this is again where we plan to design this very much in the spirit of traditional auctions like the Spectrum one that, for example, have been quite successful in allocating digital resources in the past. We think through this we can bring market forces within the permission perimeter and also ensure a high degree of compliance. Because we think that ensuring that the network can really fight financial crime and keep bad actors out and spur good economic activity will be key to financial inclusion. Over time, we also think that efforts around identity and really ensuring that we can build stronger standards for KYC would be really important in bringing a lot of those unbanked and underbanked segments online on the network. I will pause there and I look forward to discussing this with you.
So if we have any questions, please just use the raise hand function and we'll unmute you so that you can ask Christian directly. Does not look like, oh, we have Katrin.
Hello, you hear me?
Yes.
Yeah, very interesting, but I wanted to ask you a little bit more about like the plans about the future-proofness to central banks' digital currencies, because in a great simplification, one can imagine that the monetary systems in many countries remain similar to now, where it's inside and outside money. Maybe some countries will go for an option for greater control of outside money, at the extremes, the central bank's currency is only means of payments and the bank's role in creating means of payment is diminished. And the more extreme examples. So when you were talking about future-proof compatibility on that, can you give a bit more details on what you have in mind in the Libra in allowing this big range of possibilities?
Yes, and in fact, I also received a comment in the chat from Darrell on kind of on similar lines. I think the path towards CBDC integration is very much in the hands of the public sector. And so I can describe kind of a number of ways that I could envision that happening over time. As you can imagine right now, we're going to be relying on global custodians for, the handling of the reserve, whether it comes from cash or treasuries, for really the scale up of something like a Libra dollar or a Libra pound. And so we do have an established relationship with the banking system. If there is such a thing as a wholesale CBDC, you could imagine that probably banks will have access to custody of the CBDC. So a very natural transition is one where instead of having to kind of create the reserve and manage it and kind of provide transparency around it, we could essentially shift to the wholesale CBDC if that becomes a possibility. That way, you could also imagine the public sector having maximum flexibility around what are the rules around that wholesale CBDC when it comes to private money creation by the banks and other activities that may be happening. So that's one potential scenario. Now, in the synthetic CBDCs that have been proposed, you could also imagine a deeper integration between a public sector interface and the Libra blockchain. And again, it's important to think of the Libra blockchain as really as a payment network that can interface with the public sector asset, where the ultimate settlement layer of the future will always be, I think, a central bank layer. There's a number of good reasons, including a number of externalities for that to be the case. And where Libra can add value is really in extending the functionality of what that public sector, whether it's a blockchain or a digital asset distributed ledger interface can do. There's also some more low-tech solutions where you could imagine kind of similar to what happened in Asia, where you had digital wallets that were eventually asked to hold their assets, right, with traditional banks and not earn any interest on that. You could imagine a similar arrangement where the reserve would move from holding, with the custodians to holding directly with the central bank and potentially not earning any interest on that. So there's a number of models that I think may become relevant. But again, a lot of this depends on what the public sector wants to achieve as it embraces on the CBDC journey.
Okay. Do we have any further questions? I guess why don't we move on to the last presentation then? Thank you.
Okay. Okay. Our next presenter is Darrell Duffie. As many of you know, Darrell is a senior professor at Stanford. He's also a former AFA president, fellow of both the AFA and the Econometric Society, and a winner of many awards and fellowship, including the Battery March Fellowship. I remember that. Darrell, who is perhaps the leading scholar on many topics, but here specifically on the regulation of financial markets. Darrell is going to discuss digital currencies and how they will impact the financial sector. Thank you, Darrell, for agreeing to share your work here. You can perhaps share your screen and
Sure.
take over. Yeah.
Thanks so much, Kose. What a pleasure to be here. And just listening to Silvio, Garud, and Christian has inspired me to get back and continue my work on this. What I want to talk about today, as you proposed, is what this is going to do to the banking system, but also imminently, what are central banks going to do about it? That is about whether they will introduce their own digital currencies or whether they will be willing to let private digital currencies become a payment medium and how that will challenge banks, or whether banks themselves will continue as they are, but upgrade their payment systems. And we're right at the cusp of some very big decisions. Around the world, just in the last 2 weeks, we've had major announcements by the European Central Bank, the Bank of Japan, about their plans. Bank of Canada earlier this year. All three of those central banks have said, basically, we've decided we're going to start building it. That is a central bank digital currency, but we're not going to deploy it until and unless it seems necessary because some other type of digital currency is invading our financial system, or perhaps because paper is just appearing from circulation, nobody wants it anymore. And yeah, so that's the cost and benefit of digital currency is going to figure prominently in my remarks for the next few minutes, and I hope to have a good time for a discussion afterwards. So let's just review what we're all about here. Here's, if you can see my slide, this is Alice. She's at the bakery. She needs to buy a loaf of bread from Bob the baker. She needs to pay Bob $8. And you might ask, well, $8, well, yeah, a loaf of bread in Palo Alto is pretty expensive. It's always Alice and Bob somehow in these digital currency or payment system discussions. I'm not sure why. Alice and Bob get a special place in these discussions, but there they are. Now, how is she going to actually do that? Well, she could hand over $8 of paper money, but that's you know, kind of old, dirty, and not and decreasing in acceptance. Or she could use some sort of digital methods, and that's what we're going to be talking about, of course. The Swedes are introducing, it seems likely they're going to introduce a digital currency, a central bank digital currency, because Swedes rarely use cash anymore. And so they are using private digital payment systems like Swish. But the Riksbank, which is the central bank of Sweden, feels responsible for having an official government money, which seems reasonable. And they're now testing an e-krona. And there's a lot to read about that, which is quite interesting. On my last visit to Stockholm, I brought my old banknotes, Kose, and when I went to pay my hotel bill, they wouldn't accept them. Just, there's so few places now in Stockholm that will take paper money anymore. The digital way that's most common by far in the world today is to use the bank payment rails. So what happens? Alice will do some sort of swipe or wand or tap or something at a point of sale machine, and Alice's bank will get the message and will somehow, through the payment rails, which is a really complicated spaghetti, payment systems eventually get the money to Bob's bank, and Bob will receive the message that it's okay to give Alice the loaf of bread. And the payment rails that are in use today, before Christian's digital currency gets going, is pretty complicated. I mean, it may seem simple to Alice if she's using Apple Pay or something like that, but behind it, it's pretty complicated. It travels through the backbone of the banking system in a very, very sophisticated way. And it's been that way for several hundred years. By one means or another, people have been paying each other through the banking system. So Alice could be bank one. Her bank to somehow get the money through the banking system, maybe through the central bank, a central bank payment system, to Bob the baker bank, and Bob's account, who maybe he's customer 7 at bank, will get credit money. And this happens by all kinds of different technologies. This two-tiered system where everybody uses the bank payment rails, as I said, is predominant, still remains predominant today. And the big question mark is, will the official sector support this payment system, or will they go to a different payment system? And if they support this payment system, how will it get upgraded so that it better suits purposes? So I'm not going to go through the diagram, but this is just one bit of the spaghetti in the bank rail payment system, by which when Alice uses her phone at Bob the baker's, the point of sale reader at the bakery sends messages through the merchant or acquirer processor. It goes through the Visa Discovery system, which sends an encrypted message to Alice's bank, which sends back the okay, going back through, and eventually, that's only part of it, eventually it gets back to Bob's bank. So again, I'm not going to go through this because it's, while very sophisticated, it's expensive and complicated. So we're looking for something better and less expensive. One of the reasons this is expensive is that these players all along the payment rails are taking their rents along the way. Let's look at those rents. And let's look at the difference in rents in North America versus the rest of the world. By the way, I'm focusing today on general purpose digital currencies like Alice and Bob would use, but Christian also mentioned wholesale digital currencies, which also have a lot of promise. But the big deal, I think, is general digital payments, and not just cross-border. That's a lot of attention is being paid to cross-border, but the domestic problem is much bigger. So let's look at the payment stack in North America, and I want to focus on the consumer sector. You notice that the North American fraction of the stack for consumer is much, much bigger than it is in the rest of the world. And why is that? Well, it's largely because it's much more expensive to use credit cards in North America, that's 34% of the whole stack, than it is in the rest of the world. And why is that? Well, because those payments are all oligopolistic. They're both banks and credit card companies are getting very significant interchange fees and other fees relative to the rest of the world. You might say, well, yeah, this is as a percentage of the stack. Maybe the total cost in North America is not that great. Well, let's take a look at the payment revenues to GDP in the US. That stack is 2.37% of GDP. That is a lot of money to run a payment system. In Europe, Middle East, and Africa, for example, it's a bit more than half of that. So a much smaller payment stack. So while Alice's experience at the bakery may seem okay, either somehow buried in a loaf of bread or coming out of Bob the baker's profits is a pretty significant fee. And some of that is just that it's costly to run that complicated spaghetti. And some of it is that there's a lot of people dipping their beaks in this vast river of wealth flowing by the payment system, which is in the trillions of dollars a day. I'm going to skip this slide on financial inclusion in the interest of time, but I'll just point out three very interesting use cases. Vietnam, very low financial inclusion. This country, bank-based payment system, or at least using a fax-based payment system that's much more sophisticated than we have in North America. China, high financial inclusion, and high digital inclusion. We know about Alipay and WeChat Pay, and I think this is much higher even today. India, very high financial inclusion, not so much on digital payments. A lot of people have bank accounts. Fewer people use digital payments. That's going to change rapidly with UPI, which is an amazing upgrade of the whole Indian payment system. Okay, now let's talk about this innovation, which is called central bank digital currency. What does it mean? Well, in the absolute simplest form, a direct CBDC, Alice would have her account at the central bank, Bob would have his account at the central bank, and Alice would just send a message to the central bank saying, move $8 over from my account to Bob's account. Pretty simple, low cost, highly fungible across the payment system. If everybody has a payment app that connects their account at the CBDC to their mobile phone or their computer or both, it's going to be very simple and easy to move money. So what's the big deal? Well, there's a lot of big deals, and I'm going to go through them in a few minutes. This is operationally, I mean, yes, you have to build it, and you have to do it carefully, and it takes a lot of time. But there's a lot more to it than just getting this operationally to work and cutting down on the rent taking and the spaghetti in the existing payment system. A hybrid CBDC is probably the most likely alternative for most central banks. They won't give everyone an account at their central bank. What they'll do is Alice will walk into her bank and she'll say, I heard about CBDC, I have the app on my phone, can I have 500 CBDC tokens? And the bank says, sure, we carry CBDC tokens at our bank. Should the bank gives $500 to the central bank gives the bank 500 US dollar tokens, and then populates Alice's phone with 500, which she can now take and use it at Bob the Baker, or she can pay her friend Mary for dinner, whatever she wants. And everything is fine except for the interoperability problem that Christian brought up. And as he's been working on and thinking about this problem, what if Alice's bank doesn't use exactly the same payment infrastructure that Bob's bank or Mary's bank uses? The standardization of the payment infrastructure in the hybrid CBDC model is going to be absolutely crucial. It can't be they're just meeting certain international standards or domestic standards. It has to be that they're literally functionally interoperable in essentially every use case. Otherwise, Bob is going to ask Mary, well, what kind of CBDC app are you using? Because my CBDC app doesn't seem to be matching or syncing with your CBDC app. This is crucial. And it needs to go vertically right through the payment system. And it's going to be a big challenge that I don't think has received sufficient attention either among academics or practitioners. But Christian obviously is on the case. Okay, private stablecoin issuance it kind of raises the ante on interoperability, because even the backing coins are different potentially across different private stablecoin systems. So this is a schematic. You might think of it as Libra. It's not literally the same as Libra, but the idea is similar. Alice goes into her bank. She says, I want 500 of those private stablecoins. The bank puts Alice's money in a trust. The trust invests the money in some assets. It could be bank deposits. It could be treasury bills, as Christian mentioned. It could be CBDC. It could be commercial paper. You could think of it as a money fund. That trust authorizes the creation of tokens, which are given to Alice, and now she can use them to, send a gift to her daughter on Facebook, or pay for her groceries, or get a cup of coffee, or whatever she wants. Again, interoperability, but now it's a double interoperability problem because we have potentially different coins and potentially different application interfaces. The alternative, I'm going to check how I'm doing for time. We still have good time. The alternative to developing stablecoins, either central bank digital currency stablecoins or other account-based payment systems, or private stablecoins, is to upgrade the existing bank payment rails. And that project is in course right now. In Europe, you have TIPS. In the United Kingdom, you have fast payments. The US is developing FedNow. Korea has done this for 20 years. Mexico is well along. Most countries are either on their way or already have a fast payment system. What does that mean? Well, what it means is not what we have in the United States. In the United States, you could just take out the word fast, put in slow. Around, well, a big dispersion on how long it takes, but let's say a couple of days, 1 to 3 days to make payments, which is kind of crazy because now Bob has to wait. He has to pay for his inventory, but he doesn't got the money yet. He doesn't know exactly when it's coming. Slow means you can't actually move money on the payment rails unless it's bank business hours. And slow means when the payment rails are open, it's not necessarily going to get there right away. So 24/7, 365 availability, near real-time access. And there are two quite different approaches to this. One is deferred net settlement and the other is real-time gross settlement. And there are differing views on that approach. I believe the Fed is going to go for a real-time gross settlement system, which is better in some ways, worse in others. It's definitely better in terms of payment finality. That's what Silvio was emphasizing. So when the payment is made, it's received. There's no question about going back and trying to unravel things. There's no issue of credit risk, settlement delays, or anything else. Deferred net settlement is way more efficient from the viewpoint of how much cash you need to prime the system with liquidity so that you have enough cash buffers to meet payment demands intraday. I think RTGS is probably going to win. It'll be interesting though. Here are some examples of fast payment systems. I mentioned a few of these already. The United States is going slower on this than other areas. Also, with respect to CBDC, the United States, just this week on the weekend at the IMF, Fed Chair Jay Powell said on CBDC, it's not the objective of the Fed to be first. They want to do it right. He said, do it right is more important than being first. So the US is very conservative about getting this right, and it's going to take its time. Another issue with respect to the system is that in the current bank-based payment system, each bank maintains its own ledger, and now you have to do cross-ledger transactions. A two-ledger system, that means two ledgers for the entire economy, would have one ledger for the entire interbank system, including the central banks, and then one ledger that would connect all customers to their respective banks, all on two ledgers. But this technology now exists. There's a couple of startups that I've seen that are promoting this idea. It's lightning fast, it's very secure, it's highly interoperable. It doesn't require a new kind of payment medium like a CBDC or a private stablecoin. It's an upgrade of the existing bank payment rails. One of the companies that I saw doing this in Palo Alto is called M10, and you can go to their website and see what they're doing. Okay, so why hasn't this happened already with respect to CBDC? Well, introducing a CBDC has a whole list of ramifications for the economy and for the central bank. So first, on payment efficiency, I think you already got the message. It's going to improve payment efficiency in terms of cost, time lags, access, and interoperability. It seems like the dream solution, and the world is going this way. It'll also probably improve monetary policy transmission, because if the payment system is very, very highly integrated and interoperable, when the Fed Open Market Committee says we're raising rates by 25 basis points, it'll be a much closer to real-time movement of interest rates in money markets, because it'll be easier with smart contracts to move money around in search of the highest rate. So monetary policy transmission will improve. It won't be the case as when I went into my bank recently and said, well, the Fed just increased rates 25 basis points. When do I get 25 basis points more? My bank, literally, the bank manager literally said, we are thinking about that and we're going to have a meeting next month. Disruption of banking franchises. So you can imagine that that payment stack that I described for North America is going to get squashed down if you get a CBDC, because now banks are going to have to compete for payment services by offering higher deposit rates, because that's how the payment system runs. It runs on deposits, and lower payment fees. And it's going to get less cross-selling services associated with its existing payment services and deposit services. So that is going to be very disruptive to banks. And I imagine central banks are thinking carefully, how much do we want to hurt the profitability of our banking system? That's a long discussion. I have a paper on that. You can look at my website. The other issue of CBDC is, well, the banks are doing, let's call it adequate job right now on KYC, AML, CFT, and taxes. So basically the banks are the guardians of all of the illegal payments or tax avoiding payments that are being made, and they make boo-boos like, there was a few $100 billion that went astray recently in Europe. But by and large, the banking system is taking care of that. The central banks of the world are thinking, gosh, if we have a direct CBDC, we'll be in charge. And if something goes wrong, it's us. And we have to monitor all this data. And we're going to own, this is number 5, we're going to own the data problem. So we're going to be responsible for keeping the data private. If the security agencies or the investigators come after us for data, we're going to be responsible for defending the privacy. Operationally, we have to protect data security. Do we really want that problem? I imagine the central banks are asking themselves. There's the financial inclusion dimension that I already mentioned. There are financial stability issues, which I actually am much less worried about than other people are, with the possible exception of sole vendor operational resilience. There is an issue here if you run everything on one account system for the entire economy, that it's absolutely operationally resilient. There are issues of mixing banking and commerce, and there's been a lot of debate in the United States recently because the Office of the Comptroller of the Currency, which is one of the bank regulators, has indicated that it's going to give national banking charters to payment fintech firms. A payment fintech firm could be operating other businesses, and the Fed has so far, the other bank regulator has so far said, we are not in favor of mixing banking and commerce, and that's an interesting story as well. So if you want to separate commerce and banking, getting innovation and competition from fintech firms through the payment system involves trade-offs. And then finally, does the central bank really want to be called in front of Congress and say, and told by congressmen or congresswomen, you're not doing a good job on our payment system, and we've decided we're going to put a tighter amount of control on the central bank. And central bank independence is highly valued for the reasons of monetary policy. I have any comments? Yeah, I still have a few minutes. My last list of policy options for central banks. So these are not entirely mutually exclusive, but they're different paths that banks are now, or that central banks are now considering. And you should all, I mean, if we were running the Zoom poll function, or at least if I was doing this with my class, I would set up a poll and I would say, which one is your central bank going to do as a prediction? First option, use regulations and fast payment infrastructure on the existing payment rails to promote a more open and competitive bank-railed payment system. So I think that until the last 2 years, that's the plain vanilla first option of almost all developed market central banks. The main exception among large central banks is the Bank of China and the Riksbank. So that's option 1. Option 2, allow or encourage compliant private stablecoins. An example could be Libra. When Libra came on the scene 2 years ago, it completely changed the conversation. Central bankers all of a sudden said, wow, that is powerful technology. The firm that actually promulgated the idea, Facebook, already has a huge installed network of users. That is amazing. We better start thinking about this problem because that could be a competitor form of payment to our existing payment systems, and we want to investigate how disruptive that could be or how beneficial it could be. Option number 3, allow or encourage fintech firms and banks to distribute central bank backed digital currencies, subject to strong compliance and interoperability standards. This is growing as an option in central bank discussions right now. So 1 is maybe now more on a par with 3 as the policy option going forward. 3 is gaining ground. And a lot of people predict that some sort of hybrid form of central bank digital currency is going to be the policy choice for many developed market central banks. And some central banks don't want to get left behind. Option number 4, direct central bank digital currency. Give everybody an account, whether it's token-based or account-based. I actually think the distinction is not as important as people think. They're all on ledgers, one way or the other. But introduce some form of central bank digital currency, direct claims on a central bank. You get them from the central bank. You put them on your own central bank payment app. And there's no issue of interoperability, but now the central bank basically owns all of those policy concerns that I mentioned earlier. So it's really grabbing the third rail of, in many respects, security, operational resilience, political independence, monitoring, AML, CFT, tax compliance, everything, huge. Let me finish here. I simply mention there are some good things to read on this for those of you that are just getting into the topic. I've listed a few papers at the bottom. I like the Group of 30 paper that just came out recently. I was a project advisor on that report. I think it's quite a good high-level comprehensive overview of the policy issues that central banks are facing right now. So let me turn it back to Fahad and Kose, and maybe there are a few questions that we can discuss in the last remaining minutes.
Yeah, so please, if anybody has a question, please use the raise hand function. Okay, we have one.
Hi, can you hear me?
Yes.
Hi, Darrell. Always good to hear you talk. I was curious if you had any comments on this this monetary policy, sort of the mixing of keeping track of these ledgers and the central bank traditional role of interest rate management. You know, just in the same way that you talked about how we want the payment processors to be to separate their business from the payment processing itself. I think with narrow banking, you know, your colleague at Hoover, John Cochran, has talked a lot about the struggles of narrow banking in the US. It seems like for the exact same reason, maybe your hope that central bank currencies will give us better interest rate pass-through is like a very natural concern for the Fed. Do you think it makes sense to sort of separate those traditional roles of paying interest from keeping track of your money?
Okay, so let me separate, that's a great question, Jeff. Let me separate the payment side of that question, because we could have narrow banks that offer payment services, as the OCC is now considering, versus one of the points you mentioned, which is narrow banks that offer higher interest rates and create more competition for higher interest rates. On the second topic, I'm actually on the board of the Narrow Bank, which is the bank that John Cochran wrote about. And that bank wants nothing, or at least in its charter, it has nothing to do with payments. If you want to move your money from your account at TNB, you have to take it back to the account from which it came. So there's zero payment opportunities offered by TNB. It's all about competing for interest rates and offering a higher interest rate than the miserably low interest rate that Americans are now getting for their deposits. I think it's good central bank policy to allow that. Again, I'm conflicted. One of the reasons being it's better for consumers to have competitive interest rates. Competition is good in secure deposits. And there's lots more to talk about there. I also think that it's valuable to have more competitive payment services, and whether it's done through narrow banks or by regulation and better and faster payment systems, or by private stablecoins or by CBDC, I'm more open-minded. All of those might, depending on regulation, improve interest rates as well. But it's a tough decision, and the Fed so far hasn't really tipped its hand on what it wants to do. The closest it's come is its advance notice for proposed rulemaking on Regulation D, which I recommend you read. I actually don't agree with some of the things that are said in that advance notice. And if you're interested, get in touch with me. It's great to talk to you again, Jeff.
Do we have any further questions from the audience? Larry. Okay. Larry, go ahead.
Okay, this is an issue touched on by both Darrell and Christian. There's the concern about what will happen if Libra takes off, or if a developed country's central bank digital currency takes off, and what that will mean for developing countries. Any thoughts on how to deal with that problem?
You want to go first, Christian?
Sure, happy to. As you can imagine, one of the leading topics when we have conversations with central banks in emerging economies and developing countries is the risk of currency substitution. And so especially once you start having assets like a Libra dollar, Libra euro, Libra pound, and so on the network, the challenge is even possibly higher than what you would have had under the original design of a multi-currency Libra only, as really as a cross-border asset. I think the good news is that, this relates to actually, a comment that Darrell made about, the compliant versions of private stable coins. When you do have a robust compliance framework, it also means that any actor operating on the network, whether it's a VASP, an exchange, will have to comply with local rules and legislation. And so that's the right level where you can enforce anything from, for example, maximum balance limit, after which a user would have to convert to local fiat. And so very simple measures, especially given that this is a fully digital network, can really help you think through those challenges. Again, we see Libra as a payment tool. And so while we really want to encourage, for example, the network to be available so that people can send cross-border and remittances, we also want to ensure that it does not interfere with local macroprudential policy. Part of that design is also adding more of the single currency stablecoin so that the receiver can then use it on local goods and services when a remittance is received on the other end. But I think this will take time, and we're actively working on what that framework regarding compliance, ML, CFT, and sanctions really would look like to ensure that consumers are protected and that the local jurisdiction will enable access to the network rather than just full unblock it.
Well, let me tag on to that. Christian covered the compliance and payment services side. I want to speak just for a moment about monetary policy implications. Larry, this is the Larry Wall at the Atlanta Fed, right?
Yes.
Correct.
Yeah. So you can imagine if, let's say, the Fed put out a really great CBDC, fantastic, very portable, very fungible, very interoperable. Everybody that wanted it could have it on their mobile phone and use it anywhere in the world. Well, if I was the governor of a central bank of a small open economy, I would say, wow, the US dollar is now usable throughout my local economy, and it's a way better currency in terms of many of its properties than the one that we are offering. We need to do something, because otherwise, when we want to raise or lower interest rates, we can do that, but it'll be kind of meaningless because everybody's using US dollar CBDC. So I think small open economy central bankers should be thinking very carefully and maybe having international discussions well in advance of the appearance of a highly interoperable, internationally usable dominant currency CBDC. And of course, there's a good side to that. If you're operating a crappy payment system, it's an incentive to get your act together before you get dollarized or whatever the best CBDC is. But even I think for really well-compliant payment systems, there is a concern if it's a very open economy.
So I think we're right at time, actually. Kose, do you want to conclude?
I have a quick question for Darrell. So Darrell, you mentioned the US seems to be taking the view that we want to get it right rather than be fast. In competition with, let's say, another big country like China, you think the US may be going a little too slow?
Well, in the same remarks, there was also a discussion of open capital markets. And I think implicit in that, I think it was subtext for, we believe in open capital markets, and we don't, maybe I'm putting words in the mouth. Let me just say what I would think. I don't think China's CBDC, while it's going to be very, very helpful, perhaps inside China, is much of a threat to the reserve currency status of the dollar internationally, because China has, by design, a closed capital account. So it's very difficult to move money across China's borders. So there will be trickles of RMB payments that are made, and it might accelerate it from, right now it's on the order of 1% to 2% of global payments are, international payments are in renminbi. It might accelerate it to 3 or 4%, but it's not going to, unless China changes its capital controls, it's not going to really scratch the dominance of the dollar for a long time. There is some issue of competition in terms of setting standards, and China is first, and it presumably will have very good hygiene for its CBDC. It'll be robust and so on. I noticed, by the way, that China was not included in the international consortium of central banks that are doing design work on CBDC, and I'm wondering what that might be about. But first mover advantages on design do have some benefits, and I think it would be nice if the Fed had a design to roll out. So working on it as fast as possible is a good idea.
Thank you.
Oh, by the way, US is working with MIT on this, so Silvio may know something about this, and Christian may know something about it. MIT Digital Labs is actually has a contract with the Fed on the preliminary design work for a CBDC.
You guys, Christian or Silvio, you have some comments on this? Okay. Well, unless the panelists have questions for each other, I think we're going to close the session. I just want to thank all of you for a fantastic session. Silvio, thank you. Garud, thank you. Christian, thank you. And Darrell, thank you. Fahad, thank you for running the Q&A so wonderfully and organizing this whole session. Thank you all, guys. Fantastic job.